Hey everybody, welcome back to the channel. I'm Doug, the Retirement Guy, and today we have a 12% total return ETF, income ETF that really no one's been talking about. It's kind of fallen below the radar, and I was just doing some rebalancing of my portfolios, and I said, hey, I think we found something here that we need to let everybody know about. So it's a high income, strong strategy, real results, and we're going to break them all down to you today. So grab your mug, fill it with your favorite beverage, and sit back, relax, and let's see if this one fits your portfolio. Hey, before we go, we got to do the important disclaimer: this contents for educational and informational purpose only. It's not financial advice. Past performance do not guarantee future results. Now, hey, if you guys don't have your mug, don't panic, don't worry. This is what supports the channel. I know you guys are probably tired of advertisements. This supports the channel. Be able to order a coffee mug, use that QR code. You'll see everything that we offer with the Retirement Made Easy, Living on Dividends logo on coffee mugs. We got it on travel mugs. We got it on license plates. And we're probably going to go to close next because you guys have been asking for it. So thank you for your support if you have your mug. If not, enjoy the video. But everything helps support the channel so we can be unbiased on all of this and tell you guys the truth with no investors, no advertisers in our back pocket. So who is the fund that we're talking about that's giving you a 12% total return? It's going to be FTHI, the First Trust BuyWrite Income ETF. That's right. This is the fund that not a lot of people talk to and talk about, but the BuyWrite strategy. It's going to own quality stocks and it's going to sell call options, which will give you that income that we're all looking for. It's generating income with that investment confidence. So let's first take a look at the snapshot of this. What is FTHI? Well, right off the bat, the objective that they have is generate income, generate current income. The secondary is give you capital appreciation. So I always like this when you got income first, appreciation second. The fund profile, this is not something brand new. I'm not bringing you something that just popped up and oh God. And some people will say, well, 12% doesn't make me go crazy, but it's a 12% yield or 12% total return yield. Now this thing came out January 6th of 2024, so we have more than 12 years of recorded history onto this. It is an actively managed equity income fund. Has over $2.38 billion in net assets. So this is actually bigger than QQQI and SPYI, the big guns. Has 174 different holdings, 860,000 volume on average day shares traded. Okay, an expense ratio of 0.75. Now, defining that 12% total return claim, here's this. The income plus the growth, this 12-year veteran in the BuyWrite space, FTHI owns major U.S. companies and writes S&P 500 options to supercharge the cash flow. It offers monthly income in a 12% total return neighborhood, but of course it's never guaranteed. Now here's the thing. Last year alone, total return was 13.93%. 3 years out, averaged 14.05%. 5 years, 10.57%. And 10 years, this again, long-term averaging is 8.53%. As markets change, as markets grown, things have gone better. You can see the shorter term, pretty much right in that 3 years, past 3 years, they've busted through their 12%. You add 5 years into it is where you start seeing your 12% average across the board. When you get to the 10-year, starts working accordingly. So this is a very, very strong fund for total returns. So what does that mean for you guys? Well, I've been teaching you for how long now? Total returns is the actual money that you're actually generating. Your fund will either grow by or income-wise all the way through. So let's take a look at what the portfolio actually is consisting of. Well, they do this on a regular basis, but 33% is in technology. So they're more towards the S&P 500 angle is the way I put it. Financials 13%, industry 12%. Apple makes up a big package of their portfolio. Nvidia comes in next, then JP Morgan, GE, Bank of America, Amazon's in there, Costco's in there, some Dell Technology. So you can see that they're not all, when I say technology, they're not loading up on the AMDs and the all the AI stuff, Google sides of things. They're really just in the Apple, Nvidia, and they're balanced across the board. But how do they generate their monthly income? Well, the portfolio dividends, it optimizes equity selection, favoring higher dividend common stocks across multiple sectors. Then it also does the S&P 500 call option premiums. The premiums driven by selling S&P 500 call options laddered in at the money or out of the money categories to generate immediate premium used for distributions. The average time expectancy on these about 28 days, and the NAV overriding about 68%. The major strategy changed ahead on September of 26. They've already made some announcements, and I'm going to be the guy right now. I'm saying this as someone that didn't talk about it, but let me explain to you, and then you'll understand where I'm sitting on this picket fence leaning both ways. Effective September 1st of 2026, FTHI is shifting its permanent overwriting range from 25 to 75% to more aggressive 50 to 100% of the portfolio. If you've watched this channel, you would know. I've talked about this with the Goldman Sachs packages, that they have built these nice, strong S&P 500, the NASDAQ 100 funds using a 25-75 portfolio overwrite. So what that means is, as the market is growing and expanding, only 25% of their portfolio will be built for generating that income, while 75% is designed for the growth. Let it grow and get bigger. And as the market changes and the volatility changes and they go up to a 75% cap, that 75% of their portfolio is going to be written under calls, while 25% is naturally breathing to get the upside. And we've seen that it actually generates more growth than it does income. Okay? While now these guys have been doing this and been successful, but we're starting to see their aggressive package, they're going to change to a 50 to 100. So that means they're going to generate more income, which their yields are going to go up. Growth is going to come down more likely if the system stays the way that I understand it and the way they projected it. That the more income, which is what their number one target is going to be out there for it. So it's a big change going into it. It's going to upside restrictions. Upside is going to be more restricted, especially when you get into that higher 80, 90, 100% of the portfolio being covered. But the goal here is to generate more income. So the cash flow right now, the yield and the monthly distributions. So there is a wider gap across the board. They got 8.77% is what they're actually paying in their yield. I look at the 30-day SEC yield and see 0.71. So you can see that I'm not going to say a big chunk, 3/4 of a percentage point is all coming from distributions, the stock dividends and interest and all that kind of stuff, while about 8% of it's coming from actual cover calls. So if you had $100,000 put into this, you're going to collect basically $8,770, with basically giving you about a $731 estimated monthly cash flow. So good numbers. They fit very well into what Goldman Sachs has done, a few other ones have done. So the numbers and results fairly strong. Okay, using a very good quality system. And the big thing here is I looked at was the distributions. Now the recent month was at 17.9 cents per share, and the 2026 range is basically 17.2 to 17.9. So that's something that you can do in retirement. You can almost set yourself and figure you're going to get about 17 cents per month from the fund. So it's easier to budget and work around. Now the NAV. This is the big thing. Went January 6th of 2014 to July 24th of 2026, it's had an 18.8% growth. Okay, so they have some long-term growth over the long period of the fund. Now they've had a modest growth, so it's not eroding. It's nowhere close to it. We know that the thing's coming through, so we can see a nice positive growth year in, year out, over and over and over. But let's take a look at the total return. So in 1 year, as I told you, total return 13.93%. So we already know 8.77% of that is coming from our yield. So we're getting a nice 4, almost 5% growth of the particular fund. We've seen the growth has been able to handle that over the past 12 years with no problem. 3 years, 14.05, all the way through, same numbers we talked about earlier. So the 5-year growth pack, if you invested $10,000 into it, you'd have $16,527, basing it off of that 10.57% annualized total return. So it kind of shows you that it's really a strong package across the board as you let this thing ride long term. Now, value versus call costs. This is the performance of the trade-offs. What we take a look at is the FTHI's active management versus CBOE's S&P 500 call right index, and then the broad S&P 500. So what I want to show you here is, first off, when we take a look at what the S&P 500 does, this is just, S&P 500 we know is a growth fund, okay? That's all it does. It's not looking for dividends. It's not looking for income. It's designed for just growth of the top 500 companies. So in the past 5 years, it's grown 13.41% average. I don't want anyone to go crazy on me. It's 13% average over the past 5 years. While CBO using call right indexes has had a growth of 8.39%. While FTHI has grown 10.57 average. So you can see it's capturing a big chunk of what S&P 500 is actually doing, and more of the same exact call right index options that you can see is gathering more of that. So it's outperforming its peers. 10 years, same thing. So their strategy over time has definitely worked across the board. Now, the risk and the volatility and the downside that we need to talk about, okay? Now, of course, the 3-year volatility, I'm looking this for a long-term haul. If you haven't got this of the video yet, this is not one of these brand new, oh my God, funds. This is a long-term haul to show you that this could easily fit into your retirement portfolio very well, and we'll explain to that a little bit later of how to go across it. But overall, the fund has been able to not only keep up with the S&P 500, it's also been able to have a defensive stance that doesn't drop as bad. Okay, the worst reporting quarter ever was 2020 during the pandemic crash, that it lost 23% in 1 quarter. That's the worst it's ever seen. So historically, FTHI has moved significantly less than the broader stock market. However, lower volatility is not a downside protection. I got to make sure you guys understand that. But it moves less. There's less volatility that they're doing because of the stock picks that they've actually done. So guys, before we go any farther, I just got to make the big announcement that we do have the 40-ounce travel mugs in stock. They are shipping out on a regular basis. So don't be afraid to jump on with a travel mug and go forward. You can look at the link down below in the description and collect all of that. Now let's take a look at what the tax and return of capital works out to be. This is the only thing that I've been, I'll say, I have to put it and say negative on, and hate being negative, but the fun tax side of it is really using the ROC. It's a return of capital. Now, this is not a dividend in a traditional sense. It's where it returns your own investment. It reduces your costs. We've done videos on this over and over again, but we really come back with it, and I've dialed in deeper. That 89% of their distributions come back to you as return of capital. Now that's actual. I got that directly from a 1099 report, dividend report, which is the only thing you can ever go by. That's why 2025 tells me more of the story versus estimating what 2026 is. And 2026 is right on track. They're at 91.9%. So I expect that to come back right in line with the two. So this is an ROC fund. This is, other than that, that's how they handle their taxes. So it's a good thing, a bad thing, and I think they're using it as a right thing. So don't get me wrong with that. I just, if I'm in a brokerage fund, I understand ROC. I understand it. Some people don't. You got to prepare for it. You got to understand it. It can affect people in the tax side of it. So the asset location, taxable versus retirement accounts, I believe that you can use this in both funds very comfortably. Is it my first choice in a taxable account? No, but I personally know how to deal with it. I would always suggest, if you don't, talk to a tax advisor, because it really comes in your tax bracket, and your withdrawal timelines determine the winner of when you want to pull this money out and so on. In a IRA, Roth IRA, a tax-free compounding issue, it works very, very well. You got to follow the fund rules. You don't follow the government rules. What you do is, in a tax brokable account, you're going to have to depend on that ROC. The other thing is going to come to you at qualified dividends. You're going to pay higher taxes on, and you really got to watch that tax loss harvesting. Is another piece that they're starting to use a little bit onto it. Strengths and weaknesses. The core strengths. It's that income engine. The verbose monthly distributions, almost 9%, gives you that cash flow that we need in retirement. It's got a proven 12-year history. So when people ask me all the time, and this is actually where this came from, on top of all this, where it came from, is people are saying, what do you do with S&P 500? My NEOs, what happens in a bad market? What goes on with this? I always tell it's a newer fund. This one's 12 years old. So this is kind of my new go-to piece. I'm saying, well, if you're worried about that, go to this fund. It's paying you 9%, a little bit less than what the SPYI is paying, but you got 12 years of history. It's weathered the storms. It's weathered a lot of different things out there. It's got a lower volatility, the lower beta, 0.55, very low compared to the S&P 500. And it's an institutional scale, over $2 billion in assets. Now, the weaknesses is that upside cap. It is going to up it because they're doing the call options. The ROC component, it's a large return of capital portion that they're saying. Tax efficiency a little bit, but then when you don't have that, you just have point blank ordinary income, which can affect people's tax bases in retirement. Expense ratio, it's significantly higher than other things at 0.75. Not out of the game, but close to the game. And the strategy risk, the upcoming 2026. I think this is the biggest key factor I have right now. And I wanted to make sure you guys knew this, because it's not just a slam dunk done, buy it, you're over with. I just think they're going to be a very, very aggressive coming into 2026, or middle or end of 2026. Very aggressive. We're going to be watching this one. It's on my watch list very comfortably. It's going to limit the growth, but it's probably going to increase the income side. So I don't know, truthfully, if they're trying to do the NEOS game, trying to catch up to NEOS, or get to that bigger level, 10, 12% to get more people's attention. But overall, it's going to change, and it's going to be a risk. So where do you use this? The retirement income tool, where are you going to put it? No ETF is perfect, guys. I'm going to tell you that right now. No ETF is ever perfect. This one here, it kind of done some really good pieces to it. And I'm going to tell you, the monthly retirement income potential, 8.5 out of 10. I think it's just a standard roll, no problem there. Long-term capital growth, I lowered it down to 6.6 to 6 out of 10 because I don't know what that new strategy in September. I think it's going to be okay, but I hate using think when it's in my money. Lower volatility, equity exposure, excellent. I thought it was very, very strong for that one. It's a nice safety barrier. And suitable for standalone portfolios. You know, again, I see so many videos out there, people saying, can you retire just on this fund? I never would retire on one particular fund. That's why I have my 3-bucket portfolio that I use. This one here, could I make this a core? Yeah, I could use this as a core S&P 500 in my income bucket. Not a problem. Being on the conservative side, but this could be a core. I have no fear of that. But I would not make this my only fund in my portfolio across the board. So let me know what your thoughts are. Leave a comment down below. Hit that like button if you like what we're doing. To me, though, give me my final answer. I put this in more of my income bucket. It is a core holding. It goes up against SPYI. It goes up to, into the S&P 500. It really big against the JP Morgans and the Goldman Sachs. But I'll tell you straight out, FTHI is an overlooked, established option income ETF with 12 years of history. With 5 years of an analyzed return of averaging 10.57%, 10 years at 8.53. I'm really telling you guys, I think this is one thing that people have asked for a long time from me, and I'm giving it to you now, that you have a portfolio that can help look for long-term posts. Let me know what your thoughts are. Do you own this one? I'd love to see. If you own this one, let me know so I can see how many people actually knew about this ahead of time. Thanks for watching. I'm Doug the Retirement Guy, and we'll catch you next time.